The 10 tax strategies the rich use to pay less tax. 1. Retirement accounts. The wealthy understand retirement accounts are not just about 401k or IRA. They look at defined benefit plans where contributions can reach hundreds of thousands each year. The tax code allows this because the government wants to encourage saving for retirement. So what does that actually mean? It means high earners can push income into these accounts, skip paying tax now, and let it grow tax deferred. Regular folks could do the same on a smaller scale. Footnote. Retirement accounts let contributions grow without immediate taxation, creating long-term advantages. 2. Tax-deferred investments. The rich love tax deferral. Buy stock at $10, watch it grow to $1,000, pay no tax until it is sold. Same with crypto. The trick is to borrow against it instead of selling. Loan proceeds are not taxable. This is the buy, borrow, die strategy. Buy assets early, borrow money against them to live, then die and let heirs get a step up in basis. The gain disappears. Sounds unfair, but it is completely legal. Footnote. Deferring tax until sale and borrowing against assets allows growth without immediate IRS bite. 3. Loss harvesting. Losses are not always bad. If one investment goes down, sell it, lock in the loss, then buy it back later. The loss cancels gains elsewhere. Stocks have wash sale rules, crypto does not. This is why some big investors report huge losses yet still live well. They are using the losses as shields. So what does that actually mean? It means if you lost on one bet, you can still use it to protect your wins. Footnote. Loss harvesting converts losing positions into valuable tax shields against gains. 4. Real estate. Real estate is the tax code's favorite child. Depreciation allows deductions even while property values rise. Rich investors break properties into pieces, appliances, flooring, fencing, to write off faster. Bonus depreciation speeds this up even more. Add a 1031 exchange and gains roll over into new properties tax-free. Then comes the magic, pass away, and the heirs get the step up in basis again. Income for life, little tax due. Footnote. Real estate combines income with depreciation write-offs and rollover options like the 1031 exchange. 5. Charities. Charity is not just for kindness. Up to 60% of adjusted gross income can be written off with donations. Some wealthy individuals even create their own charitable organizations. Real estate can be donated at market value after years of depreciation, producing a second deduction. So what does that actually mean? It means donating strategically can cut tax bills massively, while still looking generous. Footnote. Charities provide both social good and significant deductions for the giver. 6. Trusts. Trusts are shields and transfer tools. Living trusts avoid probate. Irrevocable trusts can protect estates above the tax limit, freezing values before growth. Some trusts give income now while reserving the main gift for later. Others reduce estate tax by shifting assets early. The key idea is this: trusts move assets safely, often out of reach of both courts and tax collectors. Footnote. Trusts protect assets and reduce estate taxes by legally shifting ownership structures. 7. Businesses. Owning a business is a tax superpower. Expenses can be deducted. Income can be structured to lower self-employment taxes. Corporations, especially S-corporations, save thousands by changing how wages and distributions are taxed. Sole proprietors get audited far more and lose most cases. The rich know better. They use layers of LLCs and management companies to protect wealth. Footnote. Businesses provide deductions, reduced employment tax, and asset protection unavailable to employees. 8. Tax-free bonds. Municipal bonds pay interest-free from federal tax and often state tax too. A 5% muni bond can beat a 7% taxable bond for someone in a high bracket. Safe, steady, and clean. Not flashy, but perfect for reducing exposure while keeping income streams flowing. Footnote. Municipal bonds deliver lower returns on paper but higher after-tax value for wealthy investors. 9. Life insurance. Life insurance is not just about death benefits. Wealthy families use cash value policies to grow money tax-free and borrow against them during life. At death, proceeds are tax-free. Borrow during life, let the policy pay itself back after death. Liquidity plus tax shelter equals estate planning gold. Footnote. Life insurance policies with cash value offer tax-free growth and estate liquidity. 10. Tax-efficient funds. Certain funds are built for tax efficiency. Oil and gas partnerships generate deductions against active income. Dividend stocks and long-term capital gains are taxed at lower rates than wages. Wealthy investors balance their portfolios to maximize these breaks. So what does that actually mean? It means picking the right type of income can matter more than the size of income. Footnote. Tax-efficient funds reduce taxable income by using special sectors or favorable rates.